Want to welcome you into and thank you for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates, and Mount Partner Scott Kirshner, and myself. My name is Chris Vaughn. Really do appreciate you spending the time. Here's 419-794-3030. That's 419-794-3030. Always available online day and night. AmericasRetirementHeadquarters.com. On today's show, we're going to talk about common mistakes to avoid in this market. We're going to hear from Vice President Mike Pence on what he did after he found him suddenly retired, and more. All this and more. First, let me check in with the guys. Nolan, Scott, glad to be with you as always. How we doing today?
I'm doing great.
Well, yeah, Nolan, welcome back from D.C.
Yeah, in the hot seat, literally.
Yeah.
It's hot here in Northwest Ohio, so I think
is.
we're going to set some records this week.
Absolutely. And as we always talk about here on the show, it's not always going to be those, 72 and sunny days. You're going to have warmer days, you're going to have your colder days over the course of your retirement. So you need to make sure that you're prepared for that with proper planning to be able to withstand whatever may come down the line. And that's what we're going to do about, not just thinking about it, but also offering up suggestions and solutions to help make those possible. So again, the number, when you're ready again, 794-3030. Let's go and talk about something that is not quite so sunny and great. The chair and CEO of JPMorgan is making waves with a gloomy outlook on the economy. Jamie Dimon, pessimistic about avoiding a recession.
It's a hurricane. Right now, it's kind of sunny. Things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Andrew or something like that. And you better brace yourself.
It was one of my favorite sayings. It wasn't reading when Noah built the ark. It was a little bit more drastic than a hurricane, but let's talk about that. What do you do before a hurricane? You go into protective mode. You board up your windows. You lay those sandbags. You get generators, flashlights, food and water, things like that. Do we need to be doing the same, guys, when it comes to our retirement money?
Nolan, the crazy thing about this, absolutely we do. But, I lived in Naples, Florida. I moved down there many, many years ago. And, the craziest thing for me, being born and raised in Northwest Ohio, we have tornadoes here. But when I took a job in Naples, Florida, one of the things they did when, the new employee orientation was they stressed and made sure that everybody understood the hurricane evacuation routes. I mean, it was crazy that I would be driving down the streets, and you would see these signs posted all over, hurricane evacuation routes. It's just something different to see. I love seeing the palm trees and the flowers, every day. It's paradise down there. But, to see the evacuation routes. And one of the things they wanted to make sure was make sure that you have all of your belongings, everything that you need to grab and go, because they said literally when hurricane hits and it's time to evacuate, you evacuate. And it's very similar to what we're experiencing in the market right now. It's very up and down. The volatility is crazy. And I know with a hurricane, you don't get hurricanes every year. Sometimes you get really bad ones that hit certain areas, but it's not something that happens all the time. And we've had many conversations. We talk about the different the market is acting right now, and it's crazy right now, but you could go back and look, 4 or 5 years prior to COVID, it was pretty stable, right? I mean, it's totally different now. So for me, it was a little crazy to see the hurricane warnings and all of the signs and being prepared to if that hurricane hits, to be prepared to get the heck out of Dodge. How do you do that with investments?
Luckily for here in Northwest Ohio, we don't have to worry too much about hurricanes coming off of Lake Erie.
No, not at all.
But, we have tornadoes, we have high winds, we have, the big heat wave that's going on right now. And obviously, there's people that don't have the ability to have the air conditioning, which is why I think the libraries are open a little bit later. It's why, the senior centers are doing some things to help people out. But when you're talking about your investments, it really comes back to the concept of what I was talking about, which is about building an all-weather portfolio. So if you think about it, if you stood outside every single day here in Northwest Ohio, you'd have some beautiful days. You'd have days like today where you want to be indoors because it's too hot, and then you'd have days when it gets too cold. And it's kind of like what the stock market investor feels. They don't know what the weather forecast is going to be within the market. And so one of the things that investors can do is build an all-weather portfolio, and that is making sure that you're staying inside. You set the temperature to 70 degrees, and no matter what the weather is outside, things are kind of nice and comfortable for you. And one of the common approaches to help with that is what it's called asset allocation. And asset allocation in the traditional sense is taking money and putting a certain amount of money in stocks and then a certain amount of money in bonds. And usually what happens is stocks go up, bonds go down. But this year in 2022, we actually have not seen that happen. You've seen both stocks and bonds go down because bonds have been under pressure because of rising interest rates, and then stocks because of the uncertainty with the leadership in this country, with inflation, with the potential issues with Ukraine and Russia. There's a lot going on. So a traditional approach of asset allocation really hasn't kind of worked so well. And that's why, when looking at building an all-weather portfolio, what you want to do is maybe look at things from a different standpoint. One of the primary goals of building that all-weather portfolio is to avoid significant losses and really prolong periods of time with poor performance. And the way that you can do that is to develop an approach and what we call the independent income system, and which is really designed to look for different buckets of money, all designed to do different purposes, and also a unique strategy with the all-weather portfolio is utilizing maybe some alternatives in the strategy. So you can have things that are long and short strategies within the market. You can utilize some option type strategies to help minimize downside risk, be able to use some arbitrage or leverage, and really unconventional assets are things to kind of consider, or using alternatives like we've talked about, fixed index annuities as a bond alternative. And by doing that approach, can kind of help you weather the storm. When you're building out your independent income system, for those folks that are close to or in retirement time, what you want to do is you want to make sure that you have money set aside for the next 1, 2, or 3 years in investments that maybe aren't exposed to stock market losses and risk. So if things do go bad, you've got that money that you could count on for quite some time. Then you want to have a bucket of money that's designed to give you a pay raise in the future, because as inflation points out this year, things are going to continue to get more expensive. Even if they get inflation under control, things are still going to get more expensive. You can consider using some alternatives that are things that are other income-producing assets, maybe alternatives to the stock market. And I think, within the stock market, if you're selective right now, there's some really good opportunities. So again, an all-weather portfolio is what I would say on how to get prepared for the hurricane that maybe is already here.
Sure. I heard on the radio the last week or so, and they were talking about inflation and the cost of things, and they even talked about are we ever going to see things get back to where they were prior to this hurricane hitting? When you think about that, people are still driving, people are still going to the store, people are still doing all of this stuff. Are we ever going to get back to the low prices when you go to the grocery store? It's hard to say, because people are still paying it. They're still going out to dinner. They're still going to the movies. They're still, doing some things like that. People are accustomed to it. Do you think we'll ever get back to, $1.39 gallon of milk versus $3.39? It's, they kind of set a precedence. Hey, people will pay it. We don't need to go back to $1.39. Maybe we could go to $2.39. People will be happy that they've got $1 off now, and we're going to make a buku bucks.
Yeah, interesting thought.
Yeah.
There was actually something I heard in regards to that earlier this week as well, where they were talking about, at the beginning of the year, the government said that they had a goal to get back to the 2%, 3% inflation that we have seen previously. That's not going to happen. I can go on the record and say that. And most of America feels that way. They think that we're going to hopefully see a decrease, but still be in the 6%, 7% range next year sometime, maybe 2 years after that. Hopefully, fingers crossed, you never know. But it is important to have, that all-weather portfolio have that is going to factor in inflation. Hopefully, not as magnified as it has been in the past year, but have that growth potential in there. But also have some more structured sources of income that aren't tied to the market, as Nolan pointed out there, whether it is a hurricane that's coming, or a heat wave, or I don't know if you guys saw the video of the ice storm in Mexico City earlier this week. It was just a freak ice storm that put the entire city under the ice. These are things that They do happen, unfortunately, and you can't necessarily know what's going to cause them. You don't know what's going to cause this market downturn, but you can bet your bottom dollar that that's something that is going to happen over the course of your retirement. So you need to have that plan put in place ahead of time. You need to go ahead and weatherproof your retirement plan, and that is something America's Retirement Headquarters can help you out with. All it takes to get started, pick up the phone, give a call, 419-794-3030, or go online to americasretirementheadquarters.com, because it is a question that a lot of retirement investors are asking as the stock market continues to fall into correction territory. Is it going to go even lower? Is it going to crash? I feel like this is where having a portfolio review with you guys is one of the best ways to be ready for whatever may come. Is that right?
It really is. It's a good time to take a look at it, good time to get educated. And I'd say part of it is looking at things from a historical perspective. You know, they say that history doesn't always repeat itself, but it oftentimes rhymes. If we look at what is called intra-year declines versus calendar year returns, you know, if you go back to 1980, the S&P's down, can depend on what day of the week you look at it, somewhere around 20%. So we know that in 1987, as an example, at one point the S&P 500 index was down 34%. By the end of the year, it actually finished positive, up 2%. We also had 2001, the S&P was down 30% at one point. 2002 was down 34% at one point. And of course, '08 being the biggest one, where it was down 49% at one point. And '08 that was. And then '09, it was actually down 1 point. It was still down 28% in the beginning of the year. But at the end of the year of 2009, it finished up 23%. So using historical perspective, you know, we're down about where it's been, and it's only been about 20% of the time that the market has been more down than it is now. So that would say maybe, you know, some of the worst is past. You can also look at, you know, what the average return of an investor has been if they invested right after the bear market happened. So again, a bear market is defined as a 20% drop in the stock market. And history has shown that oftentimes, you know, it's a 20% recovery in about the first year by getting invested after the market, you know, has the downturn. So there's a lot of things that could say, be selective on what you want. I'm not saying that the end is here. In fact, one of the other things that we take a look at is what is called the Cape-Shiller Index. So Dr. Robert Shiller, who won the Nobel Prize in economics for his Shiller PE ratio and ability to look the stock market valuations, the Shiller PE ratio is still at about 29.5. And, you know, the historical average where the market should be, you know, fairly priced is more in that 16 to 17% range. So according to the Shiller PE ratio, the market right now is still risky and dangerous. It's still come back off the highs. But the Shiller PE ratio at that measurement of almost 30 shows that the risk is as elevated as it was back in 1929. So it still is somewhat of a dangerous time to take a look at some things. So again, goes back to know what you own companies that are financially sound, that have lots of cash and low debt, and can weather the storm. That's the message of what you want to take a look at, and then start selectively looking at some buying opportunities that are out there. You know, we have had, in historical perspectives, we've had markets like this. You know, this year, 2022, is one of the worst starts for the stock. If you look at the 10 worst S&P 500 index returns year to date by the end of April, you know, you can go back to 1932. The market was down about 28%. Several times that you've had market pullbacks, we've had that. And for the rest of the year, what it shows is that the average return after April of the 10 biggest declines that we've had in the history of the stock market, the average has been a 10% increase. The median has been about a 13% increase. The percentage of time it was positive after this pullback was 67% of the time. So again, put odds in your favor. Don't make the emotional decision to bail just because the market's down. In fact, the odds are getting more in your favor right now. Just be, again, selective on what you look at, and there could be some really good opportunities. One of the things that we've been talking about, too, and is another opportunity alert for those of you that are listening, you know, if you have a traditional retirement account, an IRA, what you're doing is you're deferring taxes to later. And you're saying to the government, I'll pay taxes later. Well, one, the government spent so much money that tax rates might be higher in the future. The current tax code is set to expire in the year 2025, so tax rates for a lot of people are already going to go up. And with stock prices down, one of the ways that you turn panic into opportunity is to consider the strategy of a Roth conversion. So if you had $10,000 in an investment account, and let's say because the market's down 30%, your account's now worth $7,000. You can convert and pay taxes on the $7,000 versus the $10,000. And then if you follow the rules of a Roth IRA, when you have that recovery, if it goes back up to $10,000, that $3,000 increase could be tax-free money. So that can be a way where if you look at the market right now, you don't make a panic situation, you turn it into an opportunity.
Yeah, that's a great opportunity. I love that concept. I love that idea. Nolan, I do have a question for you, though. This is something that's always kind of confused me. For a guy that's not, I'm an investor, but I'm not an advisor when it comes to the market. So in those years where it's dropped, like you were mentioning 40-some% at the beginning of the year. Okay, so if my portfolio drops, let's say 30%, use a round number of 30%. And at the end of the year, it comes back and it's a gain of 2%. Am I going to recover that 30% loss in the rest of that year?
Yeah, so if you look at that intra-year chart that I was talking about, so intra-year market returns versus calendar year returns, at one point, again, the stock market was down in our example. So it was the year 1987. And I actually remember 87 because I was cruising into Defiance in my dad's blue Astro van. And I just remember the AM radio being cranked up as the crash of 87 was happening. So again, in 87, at one point, the market, being the S&P, was down 34%. So if you looked at your account on that day, it was like, oh my goodness, my $100,000 account's down 34,000. But if you just closed your eyes and held on, by the end of the year, by the end of 1987, so by the end of the year, the market actually was positive 2%. So, the $100,000 went, all the way down to $66,000. But by not panicking and doing nothing, by the end of the year, it was back to $102,000. So again, when things are bad, people tend to get a little bit of emotion, and I understand it. It's money when you're looking at it, but the way that somebody actually loses money is when they sell.
Right.
So when you sell, you've locked in your loss. You're going to wait till things get better. You really don't have the opportunity for when the market recovers. And, nobody can predict short term when the market's going to bounce back. So making that emotional decision to get out and wait till things get better can be costly, like what the history has shown.
Yeah, my wife asked me the other day, she said, are you like watching the market? I says, yeah, where I work, right? And she says, well, what should I do? I said, absolutely nothing. I said, you're young enough to just let it ride. It'll come back. We'll be fine. Don't worry. But like you said, it hurts. It hurts to look at it. You just don't want to see it. It's like when you go to the gas pump, you see $5 or more a gallon. That really hurts. The unfortunate thing with that is you see it every time you drive anywhere. But sit tight and relax, and if you got time, it'll come back.
Yeah, you say it hurts, but it doesn't have to hurt if you look at it in the right context. So again, how do you look at it in your portfolio and say, how do I take this situation, which may seem painful, but put it in my advantage? And again, ways you can do that is you can potentially pay lower taxes now by considering the Roth. My youngest son, just this week, he was saying, Dad, whatever you do when you get home, we got to sit down and look at some of the stocks, because he sees where some of these values are. So again, if you're selectively picking things out, it's actually volatility creates opportunity. This is an opportunity. It's all in your perspective of how you look at things right now. And I'd say it's a good time to take a look at things. Again, I'm kind of biased because I'm an owner of the company and I do this, all day long. And this is what I've done since I've been 18 years old. So for the past 28 years, one of the ways that you can learn more, so if you want to turn panic into opportunity, I'd say if you haven't been out to one of our upcoming events, I would highly encourage you to register for one of our upcoming events. We've got quite a few great events coming up where we're going to be talking about the retirement basics and getting involved in that. We've got all the dates located on our website, americasretirementheadquarters.com. Just click on the events tab, and what you're going to find there is both in our Ann Arbor office, we've got some dates that are coming up here. And then we also down here in our Toledo office here in Maumee, we've got some dates that are coming up. We've got Coffee Talk on July 15th as an example. We've got in July on the 25th and 28th, Retirement Today, how to prosper in a period of decline. So very timely topics that we'll have available for you, and we can kind of coach you through the process. It's as easy as, again, going over to the website, americasretirementheadquarters.com, clicking on the events tab and registering for one of our classes that we're teaching at our local university, and happy to keep you in the loop and help you out.
Again, being able to continue the education beyond the show, getting FaceTime with the team at America's Retirement Headquarters in these educational settings. You can find out more about those by going to americasretirementheadquarters.com, clicking on the events tab. It really is all about finding opportunity in times that would otherwise be panic. You don't want to do the opposite of what everybody knows, or everyone has certainly heard the saying, buy low, sell high. You don't want to find yourself selling at lows because you panic. And if you have a little bit of discipline on your side, and I think that helps with having a plan put in place, you don't have to do that. And you could, in fact, instead of selling low because you see the numbers going down, being able to shift that mindset and buy in. This is not new. This is consistent messaging here on the show. It has been this way since the show started back in 2020 because it is something that is tried and true. It is something the team at America's Retirement Headquarters has been doing. Again, Nolan, you said before, between everybody in the office combined, 100 plus years of experience. They have seen these ups and downs. And while history, like he says, doesn't repeat itself, it certainly does rhyme. And so being able to know that the markets will go up, go down. If you have time on your side, then it is okay to stay in. If you're closer to retirement, that is where having that independent income system comes in. That is where having that all-weather portfolio really comes in, to know that, you've got consistent income available to come in for the next 2 or 3 years and be able to ride out those storms. To get started, it's really easy. Pick up the phone, give a call. Take that step now, 419-794-3030. Or you can go online to americasretirementheadquarters.com. And like we said earlier, don't forget to click on the events tab there to see about the upcoming workshops and classes that are coming up at americasretirementheadquarters.com. Because it turns out that the financial decisions that you make now, even if you are close to retirement, they can have a major impact even long after you leave the workforce. What are some of the most common mistakes that savers make that can jeopardize a plan and make it difficult to get back on track?
Yeah, so some good tips out there. There's some things that you can do as an investor right now, again, to avoid mistakes. So one of the things that you can do right now is make sure that you rebalance your portfolio. Oftentimes people will look to rebalance their portfolio. You could do it monthly, quarterly, annually, or do it in times where the market is abnormal. And one of these times right now is an abnormal time in the market. So rebalancing your portfolio helps ensure that it's really diversified, stays on track to reach your goals. And really what it does is it forces you to kind of sell off some of your winners and, maybe buy some of the losers. But those losers, again, could be good companies, just temporarily discounted in price. So rebalancing is a great strategy to make sure that you're putting in the portfolio. Another one that's difficult is like choosing your own investment strategy. So actively managing your retirement funds is riskier. It might be more time consuming. When it's our own money, we oftentimes will make irrational decisions. And the last thing you want is your behavioral bias to get in the way of your own retirement funds.
So Nolan, are you when you say that, you're not talking about me doing my own investing and moving? You're more talking about paying attention to what you have and being proactive by maybe contacting you, or are you talking about the first thing?
Well, it can be both. So, number one is I think the person who looks at their investment account every single day will probably just get more gray hair like I have. It's not a good idea to look at your account statement every single day. Some days I get on there when the market's up a lot and I look at it and I, share with the boys on how good the day is, but not every day is that good. So you don't want to look at your investments all the time. And then what I was talking about is what I would refer to as people who like to do it themselves with their own investment approach. When we teach a lot of the classes out there, we do run into people who like to do it themselves. Mm-hmm. And I'm not necessarily saying that that's not a good thing. Even our clients might have what we refer to as a sandbox account where they pick things out. The difficult part about managing your own money is it allows your emotions to get back involved in the
Right.
process. And it's not to say that you have to have us or an investment advisor manage your portfolio, but sometimes it's good to have a consulting relationship where, it's like you have somebody leaning over your shoulder and giving you advice on what
Okay.
the moves to make is. So you can bounce those ideas so you're not letting your own emotions, make those decisions. The other thing is another mistake is one I just talked about a couple of minutes ago, and that's forgetting about tax diversification. So, again, what has happened and what I've seen in my 28 years of experience is the majority of people have the lion's share of their money saved up in tax deferred retirement accounts because they were told when they get older and retire, they'll be in a lower tax bracket, so save money today. And sometimes that's true when you're in your high income earning years. But still to this day, people have a lifestyle. And if they're not working, they have more free time to go spend time with their kids and grandkids. Like I know Courtney's at the Outer Banks right now, and her, parents and grandparents are down there. The retirees today are living comfortable, that's saved and invested, and they're doing the things that they want to do. Their tax rates may not be lower in the future, let alone the fact that the government has to address the issue of their spending that they have. So don't forget about your tax diversification. If you haven't built up and started to build up tax-free funds, now may be one of the best times to do that. And then the last one I'd say is not considering all of your retirement expenses. I know, Scott, we've talked about different retirement expenses, and healthcare being one tends to be a big expense to watch out for.
Yeah, there's a lot of the unknowns with healthcare, and you just don't know what the government's going to do with your. They were talking. I just heard the on the radio the other day, Bernie Sanders, and they were talking about healthcare. It's kind of funny. We haven't heard anything about healthcare because of all of the crisis that we got going on right now. And if those weren't there, we would hear all about healthcare. But they were talking about putting dental, vision, hearing in standard Medicare. Well, yeah, that's a great idea, and I think that's something that should be done. But buyer beware. That's going to cost money. They're not going to give you those benefits without charging you a premium. So it's another way for them to get another probably $30 to $40 a month out of you. So a lot of people don't really take in all of the different long-term care expenses, your out-of-pocket expenses, your deductibles, and your prescription. Prescriptions are one that can absolutely break the bank, and I've seen that happen in quoting some $3,000, $4,000, $5,000 a year cost for prescriptions for clients is it's really tough for them to swallow. And if you don't prepare for that and take it that into account, it could really blow up your retirement.
Again, these are all the common mistakes that people make that can derail a plan without them even really realizing it. And it is important to, and I think it's very important to be aware of it ahead of time because you can correct course, avoid making these mistakes, rebalancing your portfolio over time. Taxes is huge because that money, markets are going to go up and down. They're going to fluctuate if you've got time on your side and stay the course. But as we say many times here on the show, you write that check to Uncle Sam, it's not coming back. So as important as anything else, healthcare expenses, definitely a major thing because you don't necessarily know how much it is going to be in retirement, but developing a plan ahead of time is being proactive is the best way to go there. And that starts with a simple phone call to the team at America's Retirement Headquarters. 419-794-3030 is how you do it. You can go online to americasretirementheadquarters.com. Don't forget, when you go to the website, click on the events tab over there. Register for one of the upcoming classes and workshops they have going on at americasretirementheadquarters.com. We're going to step aside for just a second, take a quick break. When we come back, we're going to hear from Vice President Mike Pence, and we commit to the 419 segment with Jim McIntyre of the American Red Cross. That conversation happens next.